I'm Mary Harmon, Product Manager at OpenWorks, and I'm joined today by Gareth McNabb, Social Innovation Lead at Nationwide. Hi, Gareth.
Hi, everyone.
Over the next 20 minutes, we'll be chatting with Gareth, asking him questions on Nationwide's approach to the credit lifecycle and the use of affordability and how to generate the best outcomes for customers. So, Gareth, what role does affordability play within the credit lifecycle at Nationwide?
Thanks, Mary. Well, my expertise with the affordability assessment in the life cycle of Nationwide starts at the back end. It starts in collections and recoveries and helping customers in financial difficulty understand how much they can afford to repay from their debts. But over the course of my time with Open Banking for Good, but then more recently as Social Innovation Lead, I've come to see the role that affordability plays right from the very beginning. So if you go back to the beginning, it's right that you assess borrowers' credit worthiness, but also their affordability. You can have a clean credit file, but struggle to afford the payments on a loan. Our regulator's been very clear for quite some time. You do both when you're a good lender, as indeed we are. Once you've worked out who you can lend to and to know that they can afford their payments, you want to check that, as a primary mortgage lender who does some consumer credit, once you've lent them their mortgage, a nice substantial loan that covers our margins, that's our core business, but you also lend on consumer credit, you want to see how much additional credit they can take. Or if you lend them on a revolving credit facility, you want to be able to understand that if they borrow the full extent of that credit line, they could afford to repay it, even if they only take a margin of it at the beginning. But then when you get into the world of forbearance and minor changes to the repayment schedule to help them through a bump in the road or one of those things where life just happens, you want to make sure that a temporary adjustment you make, like a payment holiday or short-term reduced payments, isn't something that's going to cause further financial difficulty, because the last thing you want to do with a lender is score a chronic own goal by hurting the customer and yourself when you seek to help them. So you want to be able to assess affordability at the point you offer some temporary forbearance. And then, of course, if you do get into the difficulties where you need to collect the debt or it goes into a recovery cycle with yourself or with third parties, again, you want to ensure that that repayment schedule is based on the borrower's affordability and not on any arbitrary collect it within a year or else kind of collections methodology, because collections process that's based on affordability is stickier, less costly, better for the customer and better for your own bottom line.
Cool. So then thinking about sort of bringing this right up to date, what are the things that you're seeing emerge in the credit life cycle at the moment?
So a couple of things that I'm seeing, I suppose not just within Nationwide, but also some of the third sector lenders or credit unions that I do some consulting with, and just general watching the market. I suppose you've got a couple. I've already mentioned about the importance of assessing affordability alongside credit worthiness when you're advancing loans. Credit worthiness, we would tend to use CRA data, which until this year was the core way that you do that. And perhaps the most reliable. What did we have to compare it to, frankly? But that's what we used. Now, at the end of 2020, and 1 in 7 residential mortgage customers have had a payment holiday of between 3 and 6 months this year. Understandably, rightly so. Global pandemics don't come around every year, and you need to be able to do something significant to be able to support them. But what that does mean is next year, 1 in 7 people looking to borrow any kind of money might have taken a payment holiday, might have not paid up to half of their mortgage payments in a year. Most heads of credit risk in most lenders will be scratching their heads at that, because while it was right that the government and the FCA directed that credit files not be impacted by the taking of those payment holidays to make sure people took the help that they needed to get them through the hump of a global pandemic, you want to be a responsible lender. You don't want to lend money that isn't affordable for an individual to repay. But your normal ways of assessing that might begin to be creaking at the edges. You might begin to see what some of us will have always suspected, which is that credit worthiness isn't a proxy for affordability. You should actually assess both. So one of the things that I think is emerging is the need to have additional data in your credit assessments for customers. If you rely only on the CRA data, as many lenders have to date, you're going to begin to introduce new credit risk to your world, which means you're either going to need to reduce your appetite to lend, which with interest margins where they are these days is a really silly thing to do for your business. Or you're going to need to accept a greater level of risk in your book and need to provision more money to one side. So that's one of the things. I think one of the other things is around product design and service design, where the level of forbearance that the industry was directed to offer their customers this year went above and beyond the typical features that had already been built into those products. The excellent, hard, frantic, fast work to build that kind of functionality in meant that numbers of people were able to benefit from that flexibility. But I wonder why it took that, why it took a global pandemic to make product owners realise that lending money out for, well, any length of time, frankly, whether 1 year or 25 years, to take the loan, £10,000 over 5 years is 10,000 divided by 60, stick the interest on, and make that the monthly payment every month, 60 months in a row. I don't know about you, know, but my life changed quite a lot in the last 5 years, and I expect it's going to change a lot in the next 5 years. But why loan commitments are sliced and diced exactly like that, based on the idea of the dream world, one umbrella and home, and no changes in jobs for life, and things like that. I don't think that quite fits what we all now realise is reality. And so I'm sensing a theme of the need to redesign the product and service offerings of what today to be relatively traditional financial services products. I think that's great for consumers. I think that's great for more providers. Incumbents might find it a bit harder to inject that kind of flexibility into their products or services. I'd absolutely encourage new entrants. Look, this is your opportunity to have a point of difference. Flexible credit for when life happens to you is what you and I and every sensible person are going to need 2021 onwards. And that could end up being the edge that new entrants have over incumbents.
That's really interesting, Gareth, and obviously like really close to my heart in terms of how we're designing products. But could you sort of zoom in a bit on how Nationwide approach forbearance and collections? Like, how are you helping members have that good experience?
So this is where Nationwide perhaps stands apart, and where the challenges that pandemic-related forbearance may have caused across the industry haven't necessarily affected us in the way that we do collections and recoveries. We've always prided ourselves on a really flexible approach to collections. It's always been driven by the members' ability to repay, their affordability. It's never been driven by we need to collect by date X, otherwise consequence Y. And we've also ensured that our approach to forbearance isn't just tinkering with the account. You could accept reduced payments for 6 months and then increase the payments for 6 months. And you treat a change in a customer's circumstance as a maths problem to be solved. You still owe me X amount over one period. How do I do the sums to make sure we walk away with a mutually beneficial experience? That is one way to solve that, but I don't like the idea that I am somebody else's maths problem, Mary. I'm a human being who's had something happen in my life. And so for some time now, 5 or 6 years, we've worked hard in collection recoveries to inject other services, other support to members experiencing financial difficulty. Mutuality, they're members, customers, they're members, part owners of us, not profit centres or units. And so we want to make sure that we're there for them when life happens. And so it's been my pleasure for some time to have been involved in providing the services like income maximisation and benefits entitlement calculations and support in benefits advice. If you lose your job, we're not doing a maths survival exercise. We're pointing you towards the benefits that you're entitled to, helping you claim them, and even helping you consider bolstering your career skills, your employability skills. So Nationwide's long association with Income Max, with Career Cake, and with the wider debt advice sector, I think are all proof points of how Nationwide approaches forbearance as being there for our members rather than the thing you do to try and prevent a debt going bad.
Yeah, that makes absolute sense. And obviously, you're doing a lot of work to kind of make sure that you've got accurate and reliable affordability. But what do you need to kind of prove those things, to prove that the affordability you've assessed is accurate and reliable?
I think you need a few things. I think you need a relatively common approach, and so the work that the industry, financial services and debt advice went through a few years back to establish the standard financial statement is really helpful when it comes to speaking a common language across all of the different organisations that might need to help that customer. A customer in financial difficulty with us is not only in difficulty with us, they're in difficulty with between 3 and 8 other organisations on average. Christians Against Poverty, their assessment is every client of theirs tends to have an average of 20 outstanding debts that they're in serious difficulty with. And so that standard financial statement, a common way of assessing affordability, has been materially important to customer outcomes to date. That's the framework, but then how do you complete that financial statement? That has to be an intensely human experience, I think, because it's quite a long form. Again, I don't want to be somebody else's maths problem. I want someone to help me with my problem. The way that you complete that form, whether you do it through telephony or face-to-face, it needs to be support for a customer, not data entry. It's a great opportunity to build rapport and understand the consumer's circumstances. But if you treat it like data entry to get an output, then you're going to have a really low-grade customer experience. And it could end up being quite long and harm other services you're trying to provide that customer. And when you're going to use technology, I'm passionate about open banking. Open banking for good was a great experience for me to be able to understand more about the technology and then advocate for it for customers who wouldn't typically have had it deployed into their circumstances. I think you need to not just have open banking and this gold mine of open data that everybody's thirsty for, and I'm a little less optimistic about. I'm a bit more cynical. I need open banking to prove its value to all consumers, not just the monetizable, before I think firms will be open to opening their data up. What that means is you can't just pre-populate a standard financial statement with open banking data. The standard financial statement isn't built like that from a policy point of view. And debt advisors in particular don't use it that way. It's not a point in time looking back. Debt advisors build a budget looking forwards. So open banking can inform affordability in a collections and recoveries environment and in others, but I think you need to also layer on that some other service. Now, whether open banking gives a human advisor a starting point for a conversation, or whether you layer into it some kind of conversation with that human being, AI, chatbot, I really don't mind, as long as you don't stop at, I've got open banking data and I'm going to stick it in some boxes.
Yeah, that's really interesting. I think you can get into trouble pretty quickly if you just take it wholesale without any kind of understanding of or input from the customer as well. And then broadening that out a little bit, and obviously you said you're passionate about open banking. How do you see that influencing financial services in the future?
I've been considering this one. I would hope that open banking does begin to provide one of those additional layers of data that helps the large lenders that so many people rely upon for access to credit to supplement their view of credit reference agency data. I hope that particularly the larger creditors do so really sensibly, don't switch off the CRA data and depend only on open banking, because if they've not been working with that data for a good long time, then they may not quite understand some of the vagaries of what you see coming up in that data. They may not understand quite how to risk assess cash transactions or transfers between accounts. And I feel would be that people, if they switch off CRA data and only switch on open banking data, you might find some people disadvantaged or lose access to credit that they need and would otherwise qualify for. So I think that'll help. I hope open banking does the other thing it was intended for, which is not just to provide competition between current account providers. The CMA found the famous stat, or at least I'm trying to make it famous, that the great British public are more loyal to their current account provider than they are to their spouse. More of us have stayed with our current account longer than the average length of a marriage in the UK, and that stat's been there for a number of years. So the CMA wanted open banking to increase competition rather than have the more monopolistic approach that the big current account providers have. I mean, that would be lovely. I'm personally not persuaded that competition is the best way to generate consistently fair outcomes for consumers, but I'm prepared to be proved wrong. What I do hope is that open banking will begin to deliver the genuinely new products and services that couldn't exist before it came along. I want to see open banking delivering things like genuine real-time how you're doing against your budget. So that budget in your pocket. I want to see open banking deliver ways of customers and consumers managing their mental health. I want to see open banking save lives. 100,000 people attempting suicide every year because of financial difficulty. I want to see open banking have some massive impacts on human beings and not just speed up some things that financial services already do or have to do.
Cool. And then just to wrap up and bring it back to the title of this talk, how should businesses enhance their models to make the credit life cycle like a well-oiled machine?
Well, a couple of thoughts. I mean, it all comes out in the workings of it, doesn't it? And you can have some ideas, but you actually need to be able to make them work. I think a couple of things. The first one that I would say would be making sure that your collections and recoveries function isn't an afterthought to your lending origination journey. New entrants might think, well, they can cherry pick the very best risks and deal with bad debts after the fact once they actually happen, hoping that they don't. Well, I've got news for you. They absolutely, definitely will. And so decide now how you want to service those customers in a way that's consistent with your brand. You can't say we're easy to borrow from and then be really hard to repay when you're in difficulty. You can't be friendly and nice lending the money out and then mean and tight-fisted when you're collecting it back. So you need to build your collection recoveries function now, even before you started lending, if you're in that state as an organisation. As a tech provider into lenders and organisations, you need to demonstrate, I think, that your product has utility throughout that cycle, which means you need to understand that debt collection affordability assessment is different to lending risk assessment at the front. You can't just use an SFS for lending decisions or vice versa. So I think rather than collections and recoveries being the pantomime horse, the back end of the pantomime horse of lending being built on afterwards, and well, hey, your cost of collection, that's just priced into your bad debt. I think there's a way for it to be integrated into your actual proposition and the journey that your customers go on in good times and in bad. One way that Nationwide's responding to something related to that reflection is our transition from heads of or department heads into mission leads. We are, beginning of the year, we appointed 3 mission leads to lead the 3 things that Nationwide exists to do for its members. We want to be there for their homes and their dreams. Building societies have always been there to provide the credit you need to buy land, build a house, and live in it and have a family. So we want to be there to support your homes and dreams and aspirations. A hassle-free money is the title of the second mission that we're aligned to, which is making the everyday use of money as easy and everyday as you possibly can, taking the hassle out of checking your balance, the everyday things. They should be as easy and smooth as possible. But at the same time, you're stripping complexity out of that. You want to make sure that you're there for people when life happens. And so for those moments that matter, you want to build services that really stand up and step into a member's life when they need you to do so. So you stay out of the things you don't need to be involved in, but you step right into the things that you really do. By aligning against those 3 missions that cut right across all of the verticals within Nationwide structure, and the aim is to be able to flow work and change across the business much more efficiently, which is value we can return back to our members, but also introduce the kind of ways of working that members of people listening to this would have been very used to. Transitioning a 130-year-old building society that's been more bricks than clicks perhaps into this way of working is quite some feat, but it's already having an impact on members, and we're very proud of the progress that we're making.
Awesome. Okay, well, thank you for your time today, Gareth, and for all those insights as well, and thank you to everyone for tuning in. If you'd like to hear more about what OpenWorks do, or if you want to be in with a chance of winning an Apple Watch, then head over to our virtual stand with our partners FICO. That Apple Watch offer is ending tomorrow, the 26th, at 6 p.m. So don't wait up.